5 major signals are screaming crash. The yield curve steepened. Gold surged over 50%. The Buffett indicator around 230%. Historically high PE ratios and narrow market breadth. High leverage with low liquidity. But 5 other signals are screaming rally. Corporate profits at record highs. The Fed cutting rates, inflation moderating. Government spending propping up demand. The market cycle says prosperity. 5 versus 5. S&P at all-time highs. How do you make decisions when half the signals say run and half say stay? Here's what institutions understand. When signals conflict, only one breaks the tie. And almost nobody outside Wall Street is watching it. Most investors look at market signals like they're voting, count up the bullish indicators, count up the bearish ones. Whichever side has more votes wins. That's not how markets work, and it's definitely not how institutions make decisions. Because here's what most people miss. Not all signals carry equal weight. Some measure current conditions, others predict future outcomes, and a few actually determine which direction the market moves. Think about it this way. You could have 10 signals saying the market should go up, but if the one signal that actually drives market direction says down, the market goes down. The vote doesn't matter. The mechanism matters. Right now, we've got a 50-50 split. 5 major indicators screaming bearish, 5 screaming bullish. And retail investors are paralyzed trying to figure out which side to believe. But here's where it gets interesting. Institutions aren't paralyzed at all. They're not counting votes. They're watching one specific signal that tells them which way the whole system tips. And once you see what that signal is, every other indicator suddenly makes sense. Let me show you the 5 bearish signals first, because you need to understand just how serious the warning signs are. The yield curve steepened over 12 months ago. That pattern has preceded every recession since 1969. Gold surged over 50% in 2 years. That's happened 3 times in modern history. Each time, severe economic crisis followed. Warren Buffett is sitting on $334 billion in cash, the largest defensive position in Berkshire Hathaway's history. The Buffett indicator just hit 230% of GDP. For context, it was 115% before the dot-com crash, and the market still fell 60%. The S&P's forward PE ratio is above 22, several points above its historical average. A forward PE ratio this high is typically followed by a market correction. Add in the lack of market breadth. 7 stocks accounted for over 40% of the market's gains last year, and this is particularly bearish. Margin debt is at 3.7% of GDP, near record highs and similar to 2000 and 2007. And the Fed's reverse repo facility dropped from $2.5 trillion to basically zero late last year. High leverage with a low liquidity cushion is the exact setup we saw in 1929 and 2008. 5 massive red flags. 1 or 2 of these would typically be enough to trigger serious caution. But here's the kicker. The bullish signals are just as compelling. Let's look at the 5 bullish signals, because this is where most of us get confused. Corporate profit margins are over 13% of GDP, highest in recorded history. Companies are posting record earnings quarter after quarter. When profits are this strong, stocks typically keep climbing. The Federal Reserve has been cutting rates and is positioned to cut rates aggressively in 2026. A new Fed chair takes over in May, and there's clear political pressure to lower rates. Rate cuts historically fuel massive stock rallies. Borrowing gets cheaper, money flows into equities, asset prices rise. Inflation is stubborn but not spiking. That's because the 2 biggest drivers of the consumer price index, housing and energy, are down. Shelter costs have been trending down for 2 years. Oil prices have done the same. Oil production hit 85 million barrels per day for the first time in over 7 years. And global demand is soft. High supply, weak demand, prices fall. Manageable inflation means the Fed can cut without reigniting price pressures. Government spending continues propping up demand. The federal government spends $7 trillion while collecting $5 trillion in revenue. Those extra trillions flow through the economy, supporting corporate revenues and consumer spending, keeping GDP numbers elevated. And if you follow market cycles, the Benner cycle shows we're still inside a prosperity window that should stay open through late 2026. This 150-year pattern, called the 1929 crash, the 2000 bubble, the 2008 crisis, and the 2020 low. Right now, it's showing favorable conditions for continued market strength. 5 compelling bullish signals. 1 or 2 of these would typically justify staying invested. So here's the impossible position. 5 signals saying the market should crash. 5 saying it should rally. Both sides backed by solid historical precedent and current data. How do you make decisions when the signals are split perfectly down the middle? Here's what institutions understand that retail investors don't. You don't make decisions by counting signals. You make decisions by identifying which signals actually control market direction. Think of it like this. You could have 5 sensors warning that a bridge might collapse and 5 sensors saying the bridge is fine, but if the one sensor measuring the bridge's main support beam says it's failing, that's the only signal that matters. The bridge is coming down regardless of what the other 9 sensors say. Markets work the same way. There's always one signal that determines direction when everything else conflicts. And right now, that signal is consumer spending. Here's why this is the signal that breaks the tie. Consumer spending makes up 70% of the US economy. Not 20%, not 40%, 70%. Everything else depends on it. GDP, corporate earnings, stock valuations. If consumer spending holds up, the 5 bullish signals win. Corporate profits stay elevated because people keep buying. Government spending keeps flowing through to consumer-level consumption. Lower interest rates and manageable inflation support purchasing power. The market keeps climbing. But if consumer spending breaks, the 5 bearish signals win. Corporate earnings fall. The yield curve proves correct. High leverage with low liquidity triggers forced selling. The Buffett indicator's warning materializes. Gold's crisis signal was right all along. Consumer spending doesn't just correlate with market direction, it determines it. And right now, it's sitting on the edge. And here's the part almost nobody sees. Consumer confidence is already at levels not seen since the Great Depression. Savings depleted. Household debt at $18.5 trillion. Over 60% of Americans living paycheck to paycheck. They're not spending because they feel good, they're spending because they have no choice. But here's where it all starts to click. 2 catalysts can break consumer spending, and one or both may be on the way. But first, if you're looking for stock picks, Seeking Alpha has outperformed the S&P by almost 8% over the last 12 months and by over 65% since 2022. There's a link for 10% off in the description. Now back to the 2 catalysts. Catalyst number 1, a spike in layoffs. The hiring freeze that's been masking unemployment for 18 months is transitioning to actual job cuts. Employers announced 1.2 million layoffs late last year. When people lose their jobs, spending stops immediately. No delay, no cushion, instant contraction. Catalyst number 2, a spike in inflation. If the new Fed chair cuts rates aggressively while inflation is still stubbornly elevated, prices can accelerate again. Consumers already stretched thin get crushed. Purchasing power evaporates. Discretionary spending collapses even for people who still have jobs. Either catalyst breaks consumer confidence, and when confidence breaks, spending follows shortly thereafter. That's the signal institutions are watching. Not whether the yield curve will eventually be right, not whether Buffett's cash position makes sense, not whether corporate profits can stay elevated, or if the Fed will cut rates. They're watching consumer spending. Because when it breaks, every bearish signal activates simultaneously, and when it holds, every bullish signal gets another few months of runway. So what should you actually watch to see which way this breaks? 3 specific data points give you a lot of information about consumer spending momentum. First, retail sales reports. When you see 3 or more consecutive months of declining retail sales, that's the warning shot. Not just one bad month. 3 or 4 in a row means the trend is breaking. Second, credit card and auto loan delinquency rates. When people can't pay their credit card bills or make car payments, it means they've exhausted every option. Delinquencies spike before spending collapses completely. This gives you a 60 to 90-day heads up. Third, layoff announcements and weekly jobless claims. When jobless claims jump above 250 or 260,000 and stay there, the hiring freeze officially transitions to layoffs. That's when catalyst number 1 activates. For inflation, watch the monthly CPI reports. If core inflation starts climbing again, that's catalyst number 2 forming. When signals conflict, don't count votes. Identify the mechanism that determines direction. Right now, that mechanism is consumer spending. And it's the one signal that resolves everything else. The 5 bearish signals and 5 bullish signals aren't wrong. They're both measuring real forces, but only one force actually tips the system. And institutions know exactly which one to watch. None of this is personal financial advice. This is education so you can build your own framework for navigating conflicting signals. If this changed how you evaluate market data, hit subscribe. We publish fresh content multiple times per week, showing you how to understand the economy and make better decisions, and keep the momentum going. Watch How Rich People Make Money with Inflation. It's on the screen. In the description, you'll find links for 10% off Alpha Picks. You'll also see a link to my Wealth Builders Blueprint, a large collection of resources you can use to grow your wealth. I also included a link to Zacks Confidential, a more economical alternative to Alpha Picks. Check them out. Thanks for watching. See you on the next one.